The Investment Book That Made Warren Buffett Rich, Intelligent Investor by Benjamin Graham. What if one book could completely change how you think about money and investing? This is the book Warren Buffett called the best investment book ever written. Why most investors lose money. Let's meet with Mr. Joe. I bought the stock at the rising price. Now I'm in profit. Now meet with Mr. Jason. Oh my God, market will crash more. I must sell now. Most people buy when prices are high and panic when prices fall. This emotional behavior causes huge losses. Meet Benjamin Graham, who is known as the father of value investing. His ideas have guided successful investors for decades. Core concept: a stock is not a ticker symbol. It is an ownership interest in a business. The discipline: 1. Ignore the daily voting machine of the market. 2. Focus on the long-term weighing machine of business performance. 3. Analyze the underlying worth of assets and earnings. Emotional control. Successful investing depends more on discipline than intelligence. Avoid following the crowd. Stay calm during market swings and stick to your long-term strategy. Emotions can be an investor's biggest obstacle to building lasting wealth. The Intelligent Investor teaches a value-based approach to investing. Ignore market noise. Focus on a company's true worth and make disciplined, long-term decisions that preserve and grow capital through changing market conditions. The marketplace is full of noise, emotions, and speculation. Successful investors avoid chasing rumors, trends, and market hype, focusing instead on long-term value, discipline, and rational decision-making. Intelligent investing balances safety and returns. Protect your capital through careful analysis. Seek reasonable gains with discipline, and allow patience to compound wealth over time. Speculation chases market trends and short-term price movements, while investing relies on analysis, value, and safety. Long-term success comes from understanding businesses, not predicting market timing. The Intelligent Investor identifies two paths to success: passive and active investing. The key difference is effort, not intelligence. Choose the approach that matches your time, discipline, and commitment. The defensive investor focuses on safety, steady growth, and simplicity. By minimizing risk and avoiding constant market decisions, they build wealth through patience, diversification, and long-term discipline. The enterprising investor dedicates time and effort to research opportunities, aiming for above-average returns. By treating investing like a business, they seek value through skill, analysis, and disciplined action. Higher returns require greater effort. Defensive investors spend less time and accept steady results, while enterprising investors commit more research and work to pursue better opportunities and potentially higher rewards. Whether you choose passive or active investing, the core principles remain the same. Protect your capital, control emotions, and base decisions on careful analysis. Different strategies, but one philosophy: long-term value and discipline. Successful investing rests on three pillars: analysis, discipline, and patience. Ignore market noise, make decisions based on facts, stay consistent through volatility, and give your investments time to grow and compound. Know yourself. Are you defensive or enterprising investor? Choose an investing style that matches your personality, time, and knowledge. An investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Benjamin Graham, The Foundations of Rational Investment. Pillar 1, through analysis. Successful investing begins with analysis. Focus on facts, verify business fundamentals, evaluate risks carefully, and make decisions based on research, not tips, emotions, or market hype. Pillar number 2, safety of principal. Safety of principal is the foundation of intelligent investing. Protect your capital first, minimize downside risk, and seek investments that offer security and stability before pursuing returns. Pillar 3, satisfactory return. A satisfactory return is not about chasing huge gains. Intelligent investors seek reasonable, sustainable returns that match the level of risk taken. Success comes from balancing growth, safety, and consistency over the long term. Investing is a disciplined operation, not a gamble. Every opportunity should pass 3 tests: safety to protect your money, return to grow your wealth, and analysis to understand the business. If even one fails, skip it. Discipline, not hope, creates lasting investment success. Intrinsic value is a company's true worth, while market price is what investors pay. When fear or uncertainty pushes the price below intrinsic value, it creates an opportunity. Successful investors focus on value, not emotions, and buy quality businesses at a discount for long-term wealth. The investor and inflation. Meet with Mr. Saylor. I have invested in bond. It pays 6% return yearly. Let's hear the reply of business lady Sarah. She replied to Saylor, "Oh, my dear Saylor, inflation is 5%. Your real return is just 1%. Moral: stocks often outperform in the long term, while bonds and cash may lag. Inflation steadily reduces the purchasing power of money, making wealth preservation essential. Prudent investors focus on quality businesses, real assets, growth investments, reliable income, and diversification to stay ahead of rising prices. The goal is not just to earn returns, but to grow real wealth while protecting capital over the long term. Inflation silently reduces purchasing power, making cash worth less over time. Smart investors protect wealth by focusing on quality businesses, growth assets, and diversification that can outpace rising prices. The goal isn't just higher returns, it's increasing real wealth after accounting for inflation. A diversified portfolio balances growth, stability, and liquidity to reduce risk and preserve wealth against inflation over time. The most important concept in the book is margin of safety. Price volatility is not inherently dangerous if investors focus on intrinsic value, not temporary market movements. The margin of safety, the cornerstone of intelligent investing. What is margin of safety? Always leave room for mistakes, uncertainty, and unexpected events. Market cycles bring ups and downs, so stay calm. Focus on value, not daily price swings. Always invest with a margin of safety to protect your capital. Understand the cycles, ignore the noise, focus on value, buy with a margin, and build long-term wealth. Price swings are normal, not dangerous. Real risk comes from ignoring intrinsic value. Focus on value, not volatility, to find opportunities. General portfolio policy. Defensive investor. Let's understand. What are defensive investor? Defensive investors require simplicity and minimal effort, focusing on preservation of capital. Graham recommends 1. Diversification. Allocate assets between stocks and bonds. Typically 50 to 75% stocks, 25 to 50% bonds. 2. High-quality securities. Blue chip stocks and government bonds minimize risk. 3. Regular review and adjustment. Rebalance portfolio periodically to maintain targets. This approach reduces exposure to market whims while ensuring steady, satisfactory returns over time. What are enterprising investors? Enterprising investors aim for higher returns but accept more effort and risk. Graham outlines strategies. Active stock selection. Identify undervalued securities through analysis of financial statements. Special situations. Investment in mergers, distressed companies with growth potential. Market timing caution. Avoid speculation based on short-term trends. Graham warns that while enterprising investing can yield higher returns, it requires knowledge, discipline. Intrinsic value is the true underlying worth of an investment, independent of market price. Understanding intrinsic value allows investors to buy below intrinsic value to create a margin of safety. Avoid overpaying for hype-driven stocks. Sell when the market price exceeds intrinsic value, locking in gains. Graham emphasizes careful analysis of a company's assets, earnings, dividends, and growth potential to estimate intrinsic value accurately. A company's true worth stands on 4 pillars: assets, earnings, dividends, and growth potential, together enabling accurate valuation. The margin of the safety defines the entry point. buy when market price is below intrinsic value. This margin of safety lowers risk and provides protection against errors and downturns. Sell when market price rises far above intrinsic value. Avoid hype, lock in gains early, and reduce the risk of market corrections. Let's explore the world example, the dot-com bubble. Internet stocks soared, then crashed. Many investors chased excitement and suffered huge losses when reality returned. A strong portfolio is built on clarity, protection, and profit. Invest with discipline, manage risk, and secure gains over time. Stocks for defensive versus enterprising investors. Let's meet defensive investor Madam Sophia. I focus on large, financially sound companies. Now meet Michael, who is enterprising investor. I explore undervalued or less obvious opportunities. He takes more risk, but make more profit, while Ma'am makes stable profit. Stock selection for defensive investor. Choose strong companies with stable earnings, reliable dividends, and low debt. Focus on long-term value, not short-term market hype. Stock selection for enterprising investor. Enterprising investors seek undervalued opportunities through bargain stocks, special situations, and growth companies, always guided by analysis, facts, and intrinsic value. Security analysis doesn't have to be complex. Focus on fundamentals like earnings, dividends, and asset values. Study historical trends and ignore speculation. Make every investment decision using facts, logic, and reasoned judgment, not intuition or rumors. Meet Mr. Market, your emotional business partner. One day I asked him, why do stock prices move up and down so much? Mr. Market smiled and replied, because I'm emotional. Sometimes I'm excited, sometimes I'm scared. That's the first lesson. Market prices are always changing, but a company's intrinsic value changes much more slowly. Price and value are not the same. Then I noticed two dangerous emotions, fear and greed. Fear makes investors panic and sell at low prices. Greed makes them chase rising stocks and buy at high prices. Benjamin Graham warns us not to fall into this trap. When Mr. Market becomes too pessimistic, great companies may trade below their intrinsic value. That's your opportunity to buy. Mr. Market then said something powerful. Treat me as your business partner, not your financial advisor. I simply offer you a price every day. You decide whether to accept it or ignore it. But when he becomes too optimistic, prices can rise far above intrinsic value. That's the time to sell or stay cautious. The smartest investors don't follow Mr. Market's emotions, they use them to their advantage. Remember, emotional discipline today creates financial freedom tomorrow. Let's explore a real-world example. In the 2008 financial crisis, markets collapsed. Fear dominated the market, yet disciplined investors found opportunities. Let's reveal Warren Buffett's success secret. Buffett applied Graham's principles and became one of history's greatest investors. Convertible bonds combine steady income with growth potential, while warrants let investors buy shares at a fixed price but carry higher risk. Use them only if you fully understand how they work. Investment funds. Mutual funds can simplify investing, but Graham advises, avoid high-fee funds that erode returns. Consider fund track records and management discipline. Understand the fund strategy, passive or active, growth or value-oriented. Funds can be suitable for defensive investors, but knowledge of fees and historical performance is crucial. Conclusion. Principles for the intelligent investor. Graham summarizes timeless principles. 1. Invest, don't speculate. 2. Analyze intrinsic value. 3. Maintain a margin of safety. 4. Be patient and disciplined. 5. Separate emotions from investment decisions. Always think, plan, invest, and then grow. The intelligent investor's final message. Benjamin Graham teaches that successful investing is not about being smarter than everyone else. It's about being disciplined, patient, and rational. Invest wisely, think long-term, and let time work for you. If you enjoyed this summary, please like, share, and subscribe for more book insights. And thanks to become part of our community.